So that equity you've built up in your home, it's more than just a number on a statement. It's a really powerful tool. But, it could also be a bit of a loaded gun. If you use it the right way, you can build serious wealth. But one wrong move could jeopardize everything. So let's talk about the 5 most common HELOC missteps that could put your home right on the line.
I mean, it's such a tempting idea, isn't it? All that value, just sitting there. It's so easy to start seeing it as your own personal cash reserve, just waiting to be cracked open for whatever you might want. But the psychology of easy money can be really deceptive, and treating your home like a piggy bank is probably the first big step toward financial trouble.
Just imagine it, that dream vacation, a brand new car sitting in the driveway, or, the satisfaction of just wiping out all your credit card balances. Using your home equity feels like the perfect, low-cost solution. But each one of these choices transforms your safest asset into a major source of risk. We're about to show you exactly why these seemingly smart moves can backfire spectacularly.
Okay, let's make sure we're all on the same page. A HELOC is a home equity line of credit. Now, it's a revolving line of credit, which might make you think of a credit card, but don't get too comfortable with that idea. There is one enormous difference. The loan is secured by your house. The most crucial point to remember is this: your home is the collateral. Full stop.
And we are not talking about small potatoes here. As of early 2023, Americans had a staggering $380 billion in outstanding HELOC balances. That is more than the entire GDP of some countries. It is a mountain of debt tied directly to the roofs over people's heads.
That massive number is exactly what keeps experts like Melinda Opperman up at night. And her quote, it just nails it. When we hear someone say breaking into the piggy bank, it's a warning. It's telling us that this equity should be protected and grown, not rated for everyday spending.
All right, let's get into our first misstep, and it is one of the most tempting: using your home to fund a vacation. It's the ultimate mismatch, paying for a fleeting experience with a long-term, wealth-building asset. The memories fade, but that lien on your house, that remains. Now, what's really interesting here is the comparison. At first glance, you see a HELOC rate under 6% versus a credit card averaging, 21%? The HELOC looks like a total slam dunk. But the real story is in the risk. If you default on credit card debt, you're going to damage your credit score. If you default on a HELOC, you could lose your home. That's a fundamentally different level of risk. And you know what? Even that nice low rate can be a Trojan horse. Most HELOCs have variable rates. So when the Federal Reserve hikes its prime rate to fight inflation, your cheap loan payment can jump without warning, making that relaxing vacation suddenly a whole lot more expensive. Okay, from a fleeting experience to a depreciating box of metal. Our second mistake, buying a car, is maybe the purest example of a fundamental asset mismatch. And this slide illustrates exactly why. With a normal auto loan, if things go south, they repossess the car. With a HELOC, they can come after your house. You're securing a loan with an appreciating asset to buy a depreciating one. The moment you drive that new car off the lot, it's worth less, but the loan against your home is still 100% there. It's just a losing equation from day one. Now, this next mistake is incredibly common, and that's because it feels so financially savvy at first. We're calling it the debt shuffle. And like any good shell game, it's designed to trick you into thinking you've won right before you lose big. So here's the trap. You rack up thousands in credit card debt. Then you smartly consolidate it with a lower interest HELOC. Ah, what a relief. But here's the catch. The root cause, the spending habit, was never actually addressed. Soon enough, those credit cards start creeping back up, and before you know it, you're stuck with the original debt, now secured by your home, plus a fresh pile of high-interest credit card debt. You haven't solved a problem, you've actually doubled it.
If shuffling debt is a shell game, our final category of missteps is like taking your chips to the high-stakes table and going all in. These are the gambles where you are quite literally betting the house on an uncertain outcome.
Let's start with paying for college. It's an emotional decision for any parent. But just look at this table. With a HELOC, your house is on the line, and that debt is yours, right as you're heading into retirement. Federal student loans have no collateral, and the debt belongs to the student, who has their entire earning career ahead of them. Risking foreclosure on the family home is a monumental gamble compared to the alternatives designed for this very purpose.
The other big gamble? Using home equity to play the market. This is a lesson many people learned the hard way back in the 2008 housing crisis. People borrowed heavily against homes they thought would only go up in value. When the market crashed, their investments were wiped out, their home equity vanished, but the loan remained. You're risking a secure asset on a volatile one. It's a recipe for disaster.
So after all these warnings, you might be thinking a HELOC is never a good idea. But that's not true at all. It can be a fantastic tool if you follow one simple golden rule.
And here it is. The single best use for a HELOC is to fund projects that add real, tangible value back into your home. We're talking about a kitchen remodel, adding a bathroom, or making critical structural repairs, not a new sound system.
And here's why this is the smart move. You are literally reinvesting in the very asset that secures the loan, making your collateral stronger. Plus, and this is a big one, under the Tax Cuts and Jobs Act, the interest is generally tax-deductible only when the funds are used to buy, build, or substantially improve the home that secures the loan. You're using debt to build equity, not to just fund consumption.
And that brings us right back to the beginning. Home equity is an incredibly powerful financial tool, offering low-cost capital when you use it wisely. But as we've seen, that power demands respect and a whole lot of restraint. So the final question isn't about interest rates or loan terms, it's about you. Is your financial discipline strong enough to wield this tool correctly?